Today, Tom Lee is set to unveil some critical insights for XRP holders and anyone invested in the crypto market. He's diving deep into the current economic landscape, exploring how emerging trends might shape our crypto investments. According to Tom, much of the market's attention has been glued to potential worries about a looming recession or a trade war with China causing severe economic setbacks. This fixation on negativity has kept many investors on the sidelines, cautious and hesitant. However, there's another perspective that's often overlooked. The U.S. is positioned for substantial growth opportunities, including expanded exports, reduced regulatory constraints, and fresh tax policies aimed at boosting investments. These elements don't just push up price-to-earnings ratios, they also have the potential to drive real earnings growth. Tom's main point is that you don't need to predict every detail of what's coming. With nearly $7 trillion sitting idle in cash and a generally pessimistic investor mindset, it only takes the market being wrong for things to shift dramatically. His message resonates with me because it underscores an important truth. When fear dominates the headlines, it's often the best time to take action. From my experience, I've achieved some of my largest gains by buying cryptocurrencies during sharp declines and locking in profits when the market soars. My strategy is simple. If a top 10 crypto falls by more than 10% in a single day, I buy aggressively, no questions asked. Conversely, if it spikes 15% or 20% during a bull run, I usually secure profits, especially when trading futures. Personally, I'm confident that holding XRP and HBR for the long term is the smarter play. Tom Lee covers even more valuable insights in his video, and I think it's definitely worth checking out. To truly understand the state of the economy, it's crucial to recognize that parts of the U.S. economy often in recession at any given time. Over the last 5 years, roughly 20% of the economy has been experiencing recession-like conditions, which is why analysts often refer to this as a rolling recession. This phenomenon has become more apparent with the ongoing trade war, which seems to be deepening localized downturns. However, this doesn't necessarily mean the entire economy is contracting. GDP can still grow slowly, even when certain sectors are struggling. Take the housing market as an example. It's been in a recession for 3 years now. Historically, whenever housing slipped into recession, the whole economy tended to follow. Yet, despite the prolonged slump in housing, the broader U.S. economy has remained stable. The critical question now is whether the slowdown in trade, exacerbated by the trade war, will be enough to trigger a full-blown recession. Trade has indeed been decelerating, but it's still uncertain if that alone could tip the entire economy over. One key indicator I'm watching closely is the high-yield bond market. Typically, when the spread, the difference between high-yield interest rates and safer, risk-free rates hits 1,000 basis points, it's a strong signal that a recession is looming. Currently, that spread sits at 367 basis points, which suggests we're still in the realm of rolling recessions rather than facing a broad-based economic downturn. This perspective is important because it's easy to assume that if major companies like GM are struggling, the whole economy must be in trouble. But even if GM were in a deep slump, it wouldn't necessarily drag down the entire U.S. economy. Of course, if enough sectors begin to falter, it could trigger an overall downturn. You might wonder why these rolling recessions don't just combine into one major recession. The answer is, they sometimes do, but it typically takes a major shock to trigger that kind of economic chain reaction. A significant spike in oil prices, say to $300 a barrel, would represent one such shock, driving oil expenses to about 15% of total U.S. spending, a level that has historically triggered recessions. In contrast, a financial crisis like the one in 2008, where credit markets collapsed, can also drag the entire economy down. However, when only specific sectors like housing or manufacturing are in recession, it usually isn't enough to bring down the broader economy. Recall the concerns back in 2023, when regional banks were under immense pressure. There were fears of a broader economic depression if these banks failed, given their role as critical credit firewalls. Despite the crisis, the economy held steady. In fact, back in 2022, the economy faced a series of rolling recessions that extended over 3 years, coinciding with a 27% drop in the S500, with corporate earnings only rebounding in late 2023. Many investors were convinced this combination of rolling recessions and Federal Reserve tightening would spark a deeper downturn. But we pushed back against that idea, highlighting that consumer debt levels were still low enough to stave off a major recessionary reality that still holds true today. Both businesses and consumers remain relatively unburdened by debt. Yes, job losses could materialize, which is why a recession is still possible, but anyone who is certain it's coming is likely mistaken. This sentiment is echoed by many economists right now. In my 30 years of experience, I've seldom seen economists accurately predict recessions. Often, by the time they acknowledge one, it's already well underway, as was the case back in 2008. Tom Lee's perspective on rolling recessions is crucial for understanding modern economic cycles. Unlike in past decades, when the U.S. economy was heavily dependent on single industries like oil, today's developed economies are far more diversified. We're now driven by technology, software, virtual services, artificial intelligence, cryptocurrencies, and a vast array of multinational corporations that aren't confined to any one sector. This diversification means that while a massive supply shock like oil spiking to $300 a barrel remains possible, it's less likely to be as catastrophic as it once would have been. Furthermore, much of today's commerce, especially in software, is not subject to tariffs, since it isn't tied to physical goods. Tariffs undeniably impact physical products, the everyday items we rely on. But there's much more at play than just that. As Tom Lee mentioned, while some sectors experience recessions, others continue to thrive. That doesn't automatically mean the entire U.S. economy follows the same path. For example, in 2020 and 2021, the steel and manufacturing industries faced significant downturns, affecting many jobs connected to those sectors. Yet, the broader economy kept pushing forward, and Tom Lee believes that momentum isn't slowing anytime soon. His track record adds weight to his perspective. He was among the few who predicted higher Bitcoin prices when it was still below $80,000, even when many thought the bull run was over. Personally, I was buying XRP heavily when it was under $2, convinced it was a smart move. And here we are today. That said, sharp price swings and volatility are still part of the crypto market's reality. But if XRP takes a sudden dive, I'm ready to buy more. This all ties back to a broader understanding of how the economy truly operates. I'd love to hear your thoughts on Tom Lee's view of rolling recessions and how the global economy is evolving and diversifying. Share your insights. I'm genuinely interested. And if you haven't already, make sure to join Crypto Crusaders. Over just the past 2 months, we've seen massive growth, over 267% gains. It's been incredible to witness what we've accomplished as a group. I also share my trades there.